Andreas Artemis stood outside his bank branch on Makarios Avenue, staring at the locked glass doors. He had arrived 3 hours before opening time. Behind him, a line of 200 people stretched around the block. Some had sleeping bags. One elderly woman was crying quietly, clutching her bank book like a lifeline. They all knew something Andreas refused to accept. When those doors opened at 9 a.m., the money in their accounts would be gone. Not stolen, not by hackers, not by some criminal syndicate. The government, the European Union, and the International Monetary Fund had done something nobody thought was possible in a modern democracy. They had reached directly into private bank accounts and taken the money. Legally. Andreas had 73,000 euros in his savings account. He had spent 18 years building that nest egg. By noon that day, 47% of it would vanish. Not withdrawn, not transferred. Converted into shares of a bankrupt bank that would be worth absolutely nothing within 6 months. This is not a hypothetical scenario. This happened. And right now, as you watch this video, the exact same mechanism exists in United States law, European Union regulations, and banking frameworks in 72 countries worldwide. It is called a bail-in. And the terrifying part is not that it happened once in Cyprus. The terrifying part is that your government has already written the legal code to do it to you. By the end of this video, you will understand 3 critical facts. First, how the 2013 Cyprus banking crisis created the blueprint for modern bail-in legislation. Second, how the Dodd-Frank Act Title II gave the United States government legal authority to seize and convert your bank deposits during a financial crisis. Third, why the very same pattern that destroyed savings accounts in Cyprus is being quietly assembled right now in the banking system you trust with your money every single day. Stop what you're doing and listen carefully. Because what I am about to explain is not taught in economics classes, not discussed by financial advisors, and certainly not advertised by your bank. Let me take you back to March 15th, 2013, one day before Andreas stood in that line. The Cypriot banking system was collapsing. 2 major banks, Bank of Cyprus and Laiki Bank, had made catastrophic investments in Greek government bonds. When Greece defaulted on its debt in 2012, these Cypriot banks instantly became insolvent. They needed a bailout. The traditional playbook said governments would step in, use taxpayer money, and rescue the banks. This had happened in 2008 with Bear Stearns, Lehman Brothers, AIG. Governments always saved the banks, but something different happened in Cyprus. The European Union, led by Germany's finance minister Wolfgang Schäuble, made a decision. They said no government money, no taxpayer bailout. Instead, they introduced a new term into the global financial vocabulary, bail-in. Here's how it worked, and pay close attention to the mechanism because this is crucial. Under the traditional bailout model, governments inject capital into failing banks using public funds. Taxpayers bear the cost. The banks survive. Depositors keep their money. Everyone complains about moral hazard, but life continues. Under the bail-in model, depositors become the capital. Your savings account is no longer money you can withdraw. It becomes equity. It becomes shares in the failing institution. And here is the critical legal trick that made it possible. When you deposit money in a bank, you're not storing your property in a vault. Legally, you're making an unsecured loan to the bank. The bank owes you that money, but during a bail-in, that debt gets restructured. Your claim on the bank gets converted into equity ownership of a bankrupt institution. On March 16, 2013, this is exactly what happened. The Cyprus government, under orders from the European Central Bank and the IMF, imposed capital controls. Banks were closed, ATMs were limited to 100 euros per day, and then came the haircut. All deposits above 100,000 euros at Bank of Cyprus were subject to a 47.5% conversion into bank equity. At Laiki Bank, all deposits above 100,000 euros were completely wiped out. Zero recovery. Gone. Andreas Artemis lost 34,000 euros in a single morning. He did not make a bad investment. He did not gamble on stocks. He had simply trusted his bank to hold his money. Now here is what they do not tell you in the sanitized financial media coverage. This was not a panicked emergency measure. This was a planned policy framework that had been developed years in advance. In November 2011, the Financial Stability Board, an international body that coordinates financial regulation for the G20 countries, published a document titled Key Attributes of Effective Resolution Regimes for Financial Institutions. Buried in Section 3.5 of that document was language that described bail-in powers. It outlined how authorities could write down or convert creditor claims, including deposits, into equity during a bank resolution process. This was not conspiracy theory speculation. This was official policy architecture being constructed in plain sight. And then in 2010, before the Cyprus crisis even happened, the United States passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. Title II of that law, called the Orderly Liquidation Authority, gave the Federal Deposit Insurance Corporation unprecedented powers to seize and restructure failing financial institutions. And within that authority was the legal mechanism to conduct bail-ins on American soil. Let me read you the exact language from Section 210 of the Dodd-Frank Act. It states that the FDIC has the power to make additional payments or credit additional amounts to claim holders based on the recovery value of the assets of the failed institution. Translation: the FDIC can convert your deposit claim into equity ownership if a systemically important bank fails. You need to pause and understand what this means. The largest banks in America, institutions like JPMorgan Chase, Bank of America, Citigroup, Wells Fargo, are classified as globally systemically important banks, or GSIBs. They are too big to fail. But under Dodd-Frank Title II, they are also too big to bail out with taxpayer money. So what happens when one of these institutions collapses? You bail them in. Your deposits become their capital. Now I can already hear the objection forming in your mind. The FDIC insures deposits up to $250,000. So you are safe, right? Wrong. And here's why. The FDIC Deposit Insurance Fund, as of the most recent data, holds approximately $128 billion. That sounds like a lot until you compare it to the total amount of insured deposits in the United States banking system. That number is $10.5 trillion. The FDIC has enough money to cover 1.2% of insured deposits. If multiple large banks fail simultaneously, the insurance fund is obliterated in minutes. So what happens to the 98.8% of deposits that cannot be covered? Under Title II of Dodd-Frank, those deposits get converted. You become a shareholder in a failed bank. Your savings account becomes worthless equity. And before you say this is fear-mongering, let me show you the pattern recognition that makes this inevitable. In 1931, the Austrian Creditanstalt Bank collapsed. It was the largest bank in Austria and one of the most important financial institutions in Central Europe. When it failed, depositors rushed to withdraw their money. The government tried to stop the panic by freezing accounts. Depositors were forced to accept long-term bonds in exchange for their cash deposits. Those bonds eventually became worthless. Austria's economy entered a depression that lasted a decade. In 1946, the Hungarian pengo experienced the worst hyperinflation in recorded history. The government, desperate to stabilize the currency, confiscated all bank deposits and exchanged them for a new currency at a rate that destroyed 99% of their value. People who had life savings in banks found themselves holding paper worth less than a single loaf of bread. In 1990, Brazil implemented the Collar Plan. President Fernando Collor froze all bank accounts with balances above the equivalent of $1,200. Depositors could not access their money for 18 months. When the freeze was lifted, inflation had destroyed 80% of the value. Millions of Brazilians lost their savings not to theft, but to government policy. And in 2001, Argentina faced a banking crisis. The government imposed the Corralito, freezing all bank accounts and limiting withdrawals. Depositors could only access small amounts of cash per week. Many accounts were forcibly converted from US dollars to Argentine pesos at an artificial exchange rate that cut their value in half overnight. Do you see the pattern? Every single one of these events followed the same structure. A financial crisis creates instability. The government needs capital. Instead of printing money or raising taxes, they reach into the banking system and take the deposits. They justify it as necessary to save the system, and the people who saved responsibly lose everything. Cyprus in 2013 was not an anomaly. It was the modern and legally sanctioned version of a playbook that has been used for a century. The only difference is that now, thanks to Dodd-Frank, the Financial Stability Board, and international banking regulations, the mechanism is written into law before the crisis even happens. And right now, the conditions that trigger a bail-in scenario are being constructed in real time. Let me show you the data. As of the third quarter of 2024, the Federal Reserve reports that United States banks hold $14.8 trillion in total deposits. Of that amount, roughly $4.3 trillion are uninsured, meaning they exceed the FDIC's $250,000 coverage limit. These are business accounts, municipal funds, pension accounts, and wealthy individual savings. These deposits are legally considered unsecured creditors in the event of a bank failure. Now look at what is happening with bank assets. The same Federal Reserve data shows that U.S. banks are sitting on over $500 billion in unrealized losses on their securities portfolios. This is a direct result of rising interest rates. When rates go up, the value of bonds goes down. Banks bought long-term treasury bonds and mortgage-backed securities when rates were near zero. Now those assets have lost enormous value. Under normal circumstances, this is not a problem. Banks can hold those securities to maturity and avoid realizing the loss. But if depositors start withdrawing money in large numbers, banks are forced to sell those depreciated assets at a loss to raise cash. This is exactly what killed Silicon Valley Bank in March 2023. Silicon Valley Bank had $55 billion in bonds that were worth $42 billion at market value. When venture capital firms started pulling deposits out of SVB, the bank had to sell those bonds. The moment they sold, they realized the losses. Their capital was wiped out. The bank failed. The FDIC stepped in and made depositors whole at SVB, but here is what nobody talks about. The FDIC only did that because SVB was a relatively small bank with regional impact. The total cost to the insurance fund was around $20 billion. The FDIC could absorb it. But what happens when the bank that fails is not a regional player? What happens when it is JPMorgan Chase, which holds $3.4 trillion in assets, or Bank of America with $3.0 trillion? The FDIC cannot cover that. The government cannot print enough money fast enough without triggering a currency crisis. So they use the only tool they have left. Title II, Orderly Liquidation Authority, bail in. And here is the mechanism they will use, taken directly from the Dodd-Frank Act and subsequent FDIC rulings. Step 1. The Treasury Secretary, in consultation with the President and the FDIC, declares that the failing institution poses a systemic risk to financial stability. Step 2. The FDIC is appointed as receiver of the institution. Step 3. The FDIC creates a bridge financial company to assume the assets and certain liabilities of the failed bank. Step 4. Unsecured creditors, including depositors above the insured limit, have their claims converted into equity in the bridge company. Step 5. The bridge company is restructured, recapitalized, and eventually sold or liquidated. Step 6. Equity holders receive whatever value remains after the resolution process, which in most cases is zero. This is not theoretical. This exact process is written in Federal Register Volume 76, number 211, published November 1st, 2011. It is called the Single Point of Entry Resolution Strategy, and it explicitly allows for the conversion of liabilities, including deposits, into equity. Now ask yourself this question. If your bank account gets converted into equity in a failed bank, what do you actually own? You own shares in an institution that has already been declared insolvent. You own a claim on a bridge company that exists only to absorb losses. You own nothing. Let me show you how this connects to what is happening right now. In October 2024, the Federal Reserve published its Financial Stability Report. Buried on page 32 is a section titled Vulnerabilities from Funding Risks. It states that banks remain vulnerable to rapid deposit outflows, particularly in a stress scenario. It notes that uninsured deposits remain elevated and could flee quickly in a crisis. Translation: the Fed knows that if panic starts, depositors will run, and when they run, banks will fail. Now combine that with another piece of data. The Bank for International Settlements reported in September 2024 that global debt has reached $307 trillion, the highest level in history. Corporate debt, government debt, household debt, all at record levels. When debt reaches these extremes, the system becomes fragile. A single shock can trigger cascading failures. And here's the shock that nobody is pricing in. Commercial real estate. U.S. commercial real estate is sitting on a time bomb of maturing loans. According to the Mortgage Bankers Association, roughly $1.5 trillion in commercial real estate loans are set to mature between 2024 and 2027. These loans were made when interest rates were low and property values were high. Now rates have more than doubled and property values have fallen, especially in office buildings. When those loans come due, borrowers cannot refinance at the new higher rates. They default. The banks holding those loans take massive losses. And which banks hold the most commercial real estate exposure? Regional banks and mid-sized institutions. The same types of banks that failed in 2023 with SVB and First Republic. If a wave of regional bank failures begins, the FDIC will not have the resources to backstop all depositors. They will be forced to use bail-in powers. Your uninsured deposits will be converted. And even if you keep your deposits under $250,000, the system-wide panic will cause economic chaos that destroys the value of everything you own anyway. This is not a conspiracy theory. This is risk assessment based on public data, official regulatory documents, and historical precedent. So what do? First, understand that the system is designed to protect the system, not you. The moment you deposited money in a bank, you became an unsecured creditor. You lent your money to an institution that is legally allowed to gamble with it, lose it, and then convert your claim into worthless equity to save itself. Second, diversify your counterparty risk. Do not keep all your money in one bank. Do not keep all your money in banks, period. The FDIC insurance limit is $250,000 per depositor per institution. If you have more than that, spread it across multiple banks. Better yet, hold a portion of your wealth in assets that do not depend on the solvency of financial institutions. Physical gold, real estate with no debt, productive land. These are assets that cannot be bailed in. Third, pay attention to the warning signs. If you start seeing news about bank failures, rising loan defaults, or government discussions about emergency financial measures, move fast. Capital controls once imposed are nearly impossible to escape. Andreas Artemis in Cyprus learned this the hard way. By the time he realized what was happening, the doors were already locked. Fourth, understand that inflation is another form of bail-in. If the government cannot legally confiscate your deposits, they can destroy the purchasing power of your currency. The result is the same. Your savings evaporate. The only difference is the mechanism. And fifth, educate yourself on the legal frameworks that govern your money. Read the Dodd-Frank Act. Read the FDIC's resolution plans. Read the Financial Stability Board's policy documents. These are not secrets. They are published openly. The reason most people do not know about bail-in powers is not because they are hidden. It is because nobody bothers to read the fine print. History does not repeat, but it rhymes. The patterns of financial confiscation have played out across different countries, different currencies, different political systems. But the mechanism remains the same. When governments and banks run out of options, they take the money from the people who saved it. The Cyprus banking crisis was not a fluke. It was a test case. It proved that modern democracies could seize private deposits without revolution, without riots, without collapse. And once that precedent was set, the legal infrastructure was built into every major banking system in the world. Your bank account is not a safe deposit box. It is an unsecured loan to an institution that has the legal right to convert that loan into worthless equity the moment it fails. And under current law, the government has the authority to facilitate that conversion in the name of financial stability. This is not fear. This is fact. And the difference between the people who will be destroyed by the next financial crisis and the people who will survive it comes down to one thing. Whether you understood this before, it was too late. The doors are still open. For now.